All right, welcome back. My name is Chris Sachinelli, and I get to build, buy, and sell simple profit businesses every single day. And today we want to talk about a acquisition that we've been looking at in the community. So this actually comes from one of our existing operating partners inside of the Bootstrapper Capital community. It is a deal that we just discussed this past Monday on our Monday night evening call. It's a deal that came through the pipeline. It came through actually organically through referral and relationships. And we are in the process of qualifying it and diligencing it and potentially engineering a deal that makes sense in the form of an integration and roll-up strategy, right? So let me set the scope. It's two different businesses. What we're looking at is acquiring two separate organizations. And after we acquire them, we want to bring them together. We want to integrate them and roll them up into one, right? So what are we talking about here? The first business is a training business, right? It's been around. It has a good legacy brand. It has a really strong customer acquisition base, a good strong funnel and pipe, pretty decent numbers. The numbers have been trending down a little bit. Some of the content and assets are a little bit legacy and outdated, but everything looks good in terms of the basic foundations and meat and potatoes of the business and the deal, right? The other business that we have is a marketing agency. This company's been around for 15, 16 years, really good legacy business, really strong brand and brand presence. And we all know how important that is in terms of driving customer acquisition and being able to deliver demand, right, and demand generation specifically for the services that are being provided and sold, right? Both of them have great stories in terms of the founders. Both of them are really level set and pragmatic founders looking to get to a good strategic exit. There's definitely a why behind it. So, you always got to look to the why and understand the why. And then from the why, you could build a strategy that makes sense and make it into a win-win-win type of opportunity. So that's what we're looking and aspiring to do here, right? Now, the thing is, pull back curtain, alone, standalone, each of these deals individually, they probably wouldn't make it all the way through diligence, right? The reality is both of them are in fairly what could be defined as declining markets in terms of the overall macro economic landscape, right? They both have headwinds against them in terms of changes to the overall environment, specifically and explicitly, this new cognitive revolution that's taking place with AI. So both of these businesses come with this outside negative force and effect that creates risk, right? So in a standalone capacity, neither of these deals would probably get done or pass through diligence to a point of completion, right? However, when looking at the deals together, and the reason for the video today is to show the power of being able to do deals in different ways and engineer, really kind of like the financial engineering of the deal and the deal structure. Combined, there's a story. And that story could be told. That story could potentially be sold, right? So there potentially is a deal to be done here. Let's get into the why. The why behind it. On the training business, right? So this business has been around. Realistically, what it does is it teach, trains, equips folks on how to be VAs, right? So how to get into the workforce for essence, right? So it's kind of like a human capital training vehicle, and it's been doing it for a long period of time. It has a really large number of positive reviews and a strong existing base of human capital, folks that have come through the processes and the systems and the training and the approach. All in all, it's a supply. It's a strong pipeline supply of human capital, right? Folks that want to learn how to do something, and then at the byproduct, the end of everything, the journey, know how to do it and are able to do it. That being said, that matches very, very well with this other business over here, this marketing agency. The marketing agency has been around for a long time, 15, 16 years, good legacy brand. good existing client retention. So there's cash flow. There's fairly sustainable cash flow in terms of future forecasting, present value, future cash flow, and because of that, they also have excess demand in market, or the ability to drive additional incremental demand in market for services that today in the agency, the way that it's built and designed, do not have the capacity or function or process to be able to serve. So excess demand for human capital in the market. So on one side, you have supply of folks that want to learn how to do it. And then the other side, you have the demand function for people that need that, right? Each of these individually is its own standalone business. So the cool thing here in doing this type of deal, this type of play, and what's potentially interesting here, and I don't know if we're going to do it. This is just, kind of recording the thoughts based off of yesterday's conversation, talking it through, and again, doing it all in public, right? So you can guys see how we think about these things in real time. And then fast forward videotape will give you an update if we actually end up doing this deal or not, right? So each of these individually are a viable standalone business. They do have relatively similar cash flow. These aren't exact numbers, but for essence of this conversation, this is what we'll use. It's in these ranges. They both do around 50K or so a month, or have the ability or potential to do about 50K a month, or have done so in the past, trending that way. Net, these businesses, they don't tend to trade really well, right? So we already know, on a business like this, you're going to see, like a service-based business, like an agency, you're probably going to see like a one-time multiple on the trade. Maybe you'll get 1.5 or 2, depending on brand and how much productization or systematization has gone in to the existing operations, right? There's different intrinsic factors that can kind of add those multiples. But typically you're buying a book, typically there's risk in terms of loss or churn of existing client book. There's a lot of things that could potentially change or go wrong. So for those reasons, typically you're going to even want to try to get a discount, right? So you're going to look at these typically, to discount into the acquisition. And in almost all situations, you want to mitigate that risk by, positioning some sort of earnout or carry forward of the existing owner founder, whoever's selling the business, so that they could participate and help mitigate some of that risk, carry that risk forward, right? So that they're not just cashing out up front. So really for these types of deals, and both of these businesses are fairly similar in terms of position and market and like how these deals get done. So, for the most part, you could paint broad strokes and they're kind of one and the same. This one is even a little bit more risk because some of the content is a bit legacy outdated. I think that this is also at risk in terms of macro market change, because I do think that there's going to be a shift in landscape. I think the services being provided are potentially going to become obsolete. I think that there's a good chance in the future, really quickly, the concept of Googling something or going to search to find what you want is no longer going to be the case. It's likely going to be just say what you want and cognitive apps will generate, give it to you, do it for you type of thing. So I think like traditional SEO and things of that nature are going to shift and change, with this landscape for, those reasons and probably more. So I would put a fairly high risk ratio on both of these businesses, specifically individually. Now, that being said, you could structure the deal right. So say for simplicity's sake, right? And I know the number is a little bit higher, but let's just say for simplicity's sake, we do 2 500K acquisitions. So let's say we value both of these deals at 500K. To further mitigate risk, we'll probably do it as a full earnout structure or some sort of relatively similar structure to that. An earnout being the seller is pretty much going to finance the business by carrying forward a note. So like the same way you would go and get a loan to buy something, the seller is just simply the bank. They're the folks that are extending the loan for you to acquire it. They're just loaning it to themselves. And the same way a bank gets paid back by you running the business and taking profit and then paying back the note, right, from that profit, the seller gets paid back similar. So as you're running the business, the seller is getting a percentage of the profit or a percentage of the revenue, however you structure it, or a fixed number, however you structure it, on a consistent, ongoing basis. Again, however you structure it, monthly, weekly, monthly, quarterly, annually, whatever the case may be, and it's slowly paying it down, right? So that's a fairly simple structure. That's also an easy way. There's so many different variations, but for simplicity's sake, that's a really simple way of doing something like this. And that's a great way to do a zero down deal, is just through an earnout, right? There's also different variations. So typically when we approach a deal like this, likely what we're going to want to do is we're going to come up with probably 3 to 5 different strategic type of offers that we would be comfortable making. And then we're just going to position all of those offers and then see from the seller's perspective which one ends up fitting right? What's the glass slipper that actually fits, to perfectly find our perfect match in terms of the deal to get done. This is one of those. So I'm talking through like one of what will probably be many approaches, but for simplicity of the business, the video, I just want to talk this through from the concept, the business concept behind the why that we're looking at this. So we're likely going to look to do it as a zero down type of deal, like an earn out type of deal, meaning we'll take possession of these businesses, right? We'll take possession of these businesses without any capital expenditure up front. Now, that's not to say that we're not going to have to put money in. So we're probably going to do 50 to 100K in incremental investment to, again, rehab, right? Repurpose a lot of the business in terms of the core assets, the content, to get back on point, on trajectory with where the market lives today, so that there's better viability to where it's going to be. Like, there is likely going to be an investment. And typically what we'll say is you should budget. So this would be like your incremental investment, kind of like cash on hand type of money that you should have, operating money, cash, post-deal, post-acquisition. Typically we'll say, some folks will say like pull, a month to 3 months, maybe 6 months sometimes of burn, right? I'll also use your revenue. So I also typically will look at the revenue side and say, okay, how much revenue is going in? And sometimes I'll do 50%, sometimes I'll match it, sometimes I'll double it. But for simplicity, I've just found that that's always a great way, because I don't know. I like to look at the upside, not the downside. There's different approaches to different deals for different reasons. But again, we do simple, profitable, and everything. At the end of the day, everything on the downside should be covered by the upside, right? So the upside should be the bigger number. And because it's the larger number, there should be more risk mitigation that's also taking place, more conservative deal structure for those reasons, right? So when we're looking at this, each one would be acquired for 500K, right? And the way that we would do these deals is we would end up setting up a new entity, right? So we're going to set up a new entity, right? So when we do acquisitions, most of the time, if not all of the time, most of the time, because you never can say always, most of the time, we're looking at asset-based acquisitions, meaning we're acquiring the assets and we're leaving the liabilities, right? So these aren't equity, these aren't stock deals, these are asset purchases, right? You're purchasing the assets. So you're simply stripping the assets out of the existing entity and you're bringing them into a new one. So we will be setting up a new entity. The first deal we would do over here on the training side, that's the supply side of the human capital, we would likely use that as the platform. That would become the platform play. We would do that deal first. It's the platform because it's the supply side. You can teach, train, equip that talent to do certain things, right? Certain specialized functions, roles. We're then choosing that the first one is going to be the function or role for the marketing agency. But there could be many variations of the specialized services this human capital could do. So for those reasons, I would say this is the platform, and then this becomes the first bolt-on, meaning the first deal that we're going to look at and then acquire and integrate in to start to round out the portfolio of this new entity, right? To diversify down the risk and to elevate up the synergy and the value, right? The multiple arbitrage that we're going to see from the valuations. So the marketing agency here becomes the bolt-on target, which will then buy, again, asset-based and integrate in. So we're going to then integrate and roll them up into one entity, right? So now we're working with 2 companies becoming one company, and we're going to be operating that one company. That new entity is going to be doing about 100K roughly a month, right? Because each one was doing 50. And where the magic takes place is in the wedge, right? Because by bringing them together, you're generating synergies, natural synergies of the business, and you're experiencing a lift in the form of this multiple arbitrage. So now the two businesses to combined are worth more than each of the individual parts alone, right? So the value of the two of them are equal to more than the individual businesses alone. Why? Because A, you have multiple businesses, you have multiple revenue streams now. So now you have diversification in terms of revenue risk. You have a larger customer base. You also have businesses that are feeding each other. So there's going to be a natural lift that's taking place. You have simplification in terms of operations. We're going to be able to integrate and simplify a lot of the operational expenditures. So we're going to have a reduction of expenses, right? So there's going to be a lot of natural synergies that just take place. And also because it's a larger business with more diversification of cash flow, revenue streams, and simpler operations, for those reasons and definitely more, it's a more appealing acquisition target, right? So it's a better business is realistically what we're saying. And because of that, 1 + 1 = 3, right? So instead of 1 + 1 = 2, what you're looking to do here is create this kind of manufactured multiple effect in terms of the valuations where this magic takes place and 1 + 1 = 3 magically. When you're doing these deals and you do them well, that's what ends up taking place. And what happens is because 1 + 1 = 3, a 500K plus a 500K doesn't equal $1 million. It ends up equaling 2 to maybe even 3 million if we're able to also in this process through the integration and the optimization also increase revenue, right? So if we can decrease expenses and increase revenue a little bit, we'll grow the profitability. And if we can grow that profitability, we may go from a 2 to a $3 million business, right? And there's a really good chance that that process and that approach, we call it stabilization, right? So that's the stabilization of the asset itself, right? So post acquisition, we then do integration, meaning we acquire, then we integrate, and then we stabilize, and then we optimize, right? So that stabilization to optimization, depending upon how it goes, probably 6 to 12 months for a business like this, right? So to do a deal like this, which means that in 6 to 12 months, you're building up an incremental $1 to maybe even $2 million in wedge equity, meaning the value of this business is going to be worth $1 to $2 million more than what you acquired it for. Keep in mind, though, when we acquired this and we took possession, we didn't put any money down. All we took out of our pocket was the incremental investment to have cash on hand, right, to cover operational expenses, etc., to be able to make some of these improvements that we're talking about making. Everything else was carried forward in the form of the deal in terms of an earnout. So say we hold this for 6 to 12 months. Say we hold it for 12 months, a year. We stabilize it for a year. Meanwhile, we're pulling money out, right? These businesses also had retained earnings. So there was a profitable cash flow coming off of in the first place. So you're earning this money, right? You're getting paid to own the asset realistically, right? So you own the asset now. You took possession of the asset, really no money down. You now have possession of this asset. You're getting paid to own possession of the asset because as you possess the asset, you also possess the liability. So you're realistically getting compensated to hold the liability, right, of the paper itself. But that's the cash flow. That's the profit. That's the retained earnings that you're going to be pulling out of it. And then in that process, while you're holding it and you're improving it, you're integrating it and you're elevating it, right, you're building wedge. And then you all of a sudden now 12 months later, you have $1 million to maybe $2 million in wedge equity. And you go and you sell it on the market, right? And you exit it. What you're going to do is you're going to take that money from the exit. You're going to pay out the money that's still owed to the earnout. You may give them a little bit of a kicker, depending on what the relationship is and the terms and how everything was initially negotiated, etc. But in this type of deal, you're likely going to pocket probably 100 to 250,000 in cash flow, and then you're going to likely pocket $1 million to $2 million in wedge equity. So on paper, and obviously on paper, when we're diligencing and we're looking at this and we're modeling it, it's way more sophisticated and complicated than what it looks like here, what we're talking through. What we're talking through here is like wave the magic wand, what you wish will happen, right? Paint your picture of perfect. Like that's what this would look like. It's, you pull a couple $100K in cash flow, and you're going to pull $1 million or $2 million out once the deal's done, and you didn't really put any money in, and you got operators already running the business, right? There's always hair on the deal. Nothing's ever perfect. Things don't always work out the way that you want them to for a number of reasons, and definitely more. But this is like a high level sense of what it could look like or what you want it to look like as you're diligencing it and working through it. Next step after this is we go through the full diligence checklist, right? So we're going to pull the information that we need to actually diligence these businesses. We're going to run through the financial modeling on them individually. We're going to run different scenarios. And then the byproduct of all that are going to be a couple of different deal structures that become options, right? So we're going to create, our job is to create 3 to 5 options for how we could get these deals to be done, where it's still all of them make sense, but you create that optionality for the seller to figure out what makes the most sense for them. And then you execute onto the deal, right? We'll put together our plan, our 100-day plan. Typically, we're just going to follow the Simple Profits playbook, right? Pretty much to a T. And then you just execute. It's all about integration, execution, and then hopefully a little bit of optimization before we potentially exit out of it. This would be a deal that we'd probably want to exit out of, again, because there's macro market shifts taking place, and I'd rather not hold the risk, for long. But who knows? Maybe after we do all of this stuff, that changes, and we see like, okay, now we actually skated to where the puck's going to be. We got ahead of the curve. We're on trend. We're in front of trend, and we're going to be, riding that wave, and we want to hold it. We want to hold it, we want to cash flow it, and we want to arbitrage off of more of an equity wedge, right? So for all of those reasons and definitely more, this is a deal that we're considering. This is a real deal that we're discussing in the community. It came from one of our operating partners. If you want to join, if you want to have these types of conversations, definitely check it out at bootstrappercapital.com. You can join the community. If you want a little bit of help doing these types of things, or maybe you own a business and you're trying to build wedge equity in your own business and maybe double the valuation, check out simpleprofits.io. That's our advisory business where we do for others what we do for ourselves, right, at Bootstrapper Capital. All right, if you watched this far, I appreciate it. Please like and subscribe, and let us know in the comments if you like this type of content, and we'll provide more of it in the future.